Ouch, that jobs report. Welcome back to the channel where my goal is for you to become more knowledgeable in the real estate market and for you to feel more confident the next time you purchase a home or sell a home. If you'd like this content, give it a like and subscribe to the channel. And now for that jobs report. The latest job report showed us something very interesting, and the effect that it could have on mortgage rates is something that you're going to want to pay attention to. So job creation surpassed all forecasts. The expectations for January is going to be about 200,000 jobs. What we ended up seeing was that over 500,000 jobs were created. While we can see that as a positive, really the bigger picture is what it's doing to inflation. So what this job reports mean is that more people are employed, meaning that they have more money in their pocket. So if you understand inflation, it means that there is a high demand on a product and not enough supply for that product. So we have too much money chasing not enough goods. This is why we saw the Fed rates being increased aggressively last year and a little bit more as well this year. So how will this affect mortgage rates? Really what investors are looking for is for a weaker economy. This means that spending will decrease and the supply can catch up. So whenever you see rates that we were seeing over than a year ago, because we were wanting to see demand rise. And that's what we got. If you saw my last video where I interview a mortgage lender, he told us to keep an eye on the 10-year treasury. And before the Feds announced their rates, we saw that the 10-year treasury was actually going down some. And so the mortgage rates followed. But with this recent jobs report, we saw the mortgage rates go up. Reason being is that the market is expecting for inflation to go back up. And what we were seeing before this jobs report is that the mortgage rates were starting to plateau. So what does this mean for buyers? Well, a good takeaway from this is that as the Fed raised their rates to tackle inflation, some buyers will drop out of looking for a home. This gives the buyer more purchasing power. As the large pool of buyers dwindle down, buyers will not feel the pressure to buy immediately compared to what we saw last year. But what does this mean for sellers? As some buyers start to drop out of the market, what we will see is more listings staying on the market longer. So sellers, it will be very important to set your expectations. Don't expect to sell your home for the same price that your neighbor may have sold 3, 4, maybe 5 months ago. So listen to your real estate agent and think creatively on how to incentivize buyers to buy your home. So as you go into the market, whether to buy or to sell, just keep an eye on what is happening with inflation, with the 10-year treasury. This will give you a better idea on what to expect. If you're an agent watching this, what are you seeing in your market? Let me know in the comments below. Well, thank y'all for watching. If you really like this content, go ahead and subscribe to the channel, and I will see y'all in the next one.